So much for that introduction, Ed, and thank you, Steve. Such interesting insight, and I already am going through another cup of Starbucks coffee. So I really enjoyed listening to what you had to share today as well. So, as Ed mentioned, my name is Megan Klein, and Brian and I are both excited to share a bit about Arity's recent insights into how driving behaviors have really continued to change in 2020. And the reality is that we've never really seen anything quite like this pandemic in our life. And I'm sure you guys are sick of actually hearing that. Any presentation, any webinar, any conference you attend right now, everyone's talking about how this is unprecedented, but it really is. And if you're anything like me, at times you felt a bit uncertain, maybe even scared. But here at Arity, we really believe that knowledge is power. And by better understanding some of the data and the insights that we're going to present, we feel we can be better equipped to adjust to the changes that we're seeing and recognize which of these types of behaviors are more of a one-time event, maybe a blip, and which of the behaviors will be sustained as we continue to move through the pandemic. So by the end of this presentation, by the end of this hour, we're hoping that you'll have taken away some new and unique insights of the current views today that might be helpful for insurance companies to understand as we all adjust and figure out how to respond to the pandemic, especially in the auto insurance industry. All right, a little bit of housekeeping before I get started. I did see that the chat was being used quite a bit for questions, and so we will ask you to go ahead and throw those in the chat. We likely won't cover the questions until the end of the presentation, since we do have a pretty dense deck that we're going to walk through, but we hope to allow some time at the end to come back and revisit those questions that you had. Also, before we get started, anytime we gather a number of different insurance companies together as we have today, it is really important for us to recognize and make sure that we are not exposing ourselves to any type of antitrust risk. We need to be conscious of that potential opportunity. So we have a quick legal disclaimer to guide our conversation. All right. So as I'm sure you are all familiar with and might have even heard in the start of this industry day that you're having, when we participate in forums like these, we need to be very mindful of adhering to both the letter and the spirit of all antitrust laws. So here's a statement that Arity has prepared to that effect. This statement will guide all of Brian and I's discussion here today, and we expect that all on the call will be following it as well. To summarize, we've designed this presentation in such a way to ensure that no competitively sensitive information will be disclosed and there's no opportunity for any anti-competitive understandings. That means we will stick to the agenda that we've created and not discuss any individual company trends, any rates, or other competitive information, and you should not either. All right. So with that behind us, let's do a quick introduction. Ed, I appreciate the introduction to Arity, but we think it's helpful to orient some of the new folks to what we do as a company so you all can understand the context and experience from which we draw. So to start, Arity is a mobility, data, and analytics company, and we partner with a variety of industries. These industries can include working with insurance companies, working directly with automobile OEMs, working with shared economy companies, and that includes companies that provide car share or ride share services, as well as gig delivery platforms. And we also partner directly with mobile applications, direct to consumer type mobile apps. And for all of these businesses, we help their drivers better understand their own behaviors on the road so they can manage their risk while they're out there. And part of our insights really help us drive those drivers to exhibit safer behaviors, to help the businesses that serve their drivers move forward in a way that is most effective for what they're trying to accomplish. Now, given all of these partnerships, we are able to have access to over 390 billion miles of historical anonymized driving data, and we have more than 23 million active telematics connections. Partner that with over 10 years of experience in analyzing driving data from both mobile applications as well as directly from the vehicles themselves, and pairing that with our understanding and awareness of how those behaviors influence risk on the road, we are uniquely equipped to provide perspective on personal mobility in general, but especially during this pandemic. So for us, when we think about telematics data, there are a lot of different insights that we can pull from this. And we kind of categorize these into main buckets as we try to understand driving behavior. That includes how much people are driving, when, where, and how. So we're going to start today's presentation by digging in with some high-level views of how mileage trends have continued to evolve in the wake of the COVID-19 pandemic. We will touch on how much individuals have shifted their driving, as well as how that can look differently based on where people live and even their own individual circumstances. One thing that you'll learn is our country is not a monolith, nor is any one state. So you really need to dig in deeper at that local level to see what is happening. And fortunately, we have the data to accomplish that. After that, we'll share some insights into how driving behaviors continue to change, diving into more of the how and when people are driving, better understanding if our morning commutes are looking different, or are people returning back to their pre-pandemic types of behaviors. And lastly, I'll review some of our insights into the customer sentiment around the use of driving behaviors for insurance rate making, because we really think this pandemic has impacted the customer acceptance of telematics in a really interesting way. Now, throughout the presentation, we'll be providing insight into the potential implication of these trends for insurance companies, whether it's improving your understanding of risk or addressing new regulatory questions. So let's go ahead and start diving in. With that, I'm going to turn it over to Brian, who will start us off by digging into some of those mileage trends.
Thanks, Megan. We're excited to share some insights into how the pandemic has affected driving behaviors thus far. Hopefully, these insights will allow you all to start thinking about how COVID-19 might continue to impact auto insurance beyond what we've already seen. We like to anchor our presentation in our mileage analysis, as this is where the story starts. But before we get into that, let's discuss the data we used for developing this presentation first, to give you all a perspective of how helpful in general these ideas and insights might be. This image is a picture of the GPS points for all the trips we collected from a single day back in January earlier this year. This visualization should help you understand the granularity of the telematics data that we have, along with the impressive coverage we have across the entire country. You could even see some of the smaller arterial roads, and actually, in fact, about 60% of our data comes from these smaller roads. So it's clear that this robust data set provides us the opportunity to get a very precise picture of mobility across the country. One thing that's important to point out about this data is that there were a variety of sources, both insurance and non-insurance, that were used to develop it. The data sources are not solely reflective of any individual Arity affiliate company or any other particular industry or source. The data is collected via both mobile devices, where our software will run in the background of our clients' mobile applications, and plug-in devices that go directly into the vehicles. We bring together all these different sources of data and know how to control for the variances between those sources, which gives us this combined data source. This allows us to provide an overall picture of personal driving patterns across the country. Now that we're a little bit more familiar with the data behind this, let's dive into the insights related to mileage. So first, I'd like to orient you to the top left chart, as this type of chart will occur several times throughout the presentation, so understanding how to interpret it is quite important. For this particular view, we are looking at the number of trips per monthly active connection for each day since shortly before we started observing shifts in driving behavior. The chart is indexed to the amount of driving recorded on February 2nd, a full month before the effects of pandemic started being felt. For reference, we've also included a dotted line to signify the state of national emergency declared on March 13th. The dark blue heartbeat looking line has the observed number of trips taken each day indexed to that February 2nd date. We see this jagged pattern because the number of trips taken on Friday actually differs pretty significantly from the number taken on Sunday. To make it easier to interpret the results, we smooth out those daily variations with the darker blue curve that we label observed. As a point of comparison, we also included a light blue line called the counterfactual. This line is based on 2019 data after we apply some time series methods to make it more appropriate for comparison. Think of this counterfactual line as what we would have expected to happen had the pandemic never occurred. By comparing the light blue and dark blue lines, you can get a sense of how close to normal or how far away we are. The difference between these values is shown below in the orange line, allowing for an easy comparison to pre-pandemic levels. So back up to the top left chart, a few things should pop out. First, after the state of emergency was declared, we see a precipitous drop in the number of trips taken per monthly active connection. And that decline ultimately bottoms out in mid to late April. Next, we see that the number of trips per monthly active connection begin to slowly but steadily increase throughout the rest of April, May, and into June, until it reaches this new steady state that we've seen. From June until September 25th, which is the last day that's actually included in this analysis, we see that the results have been fairly stable. Overall, we're between 10 and 15% below the average number of trips taken compared to the pre-pandemic levels. On the right-hand side, we have the same view, but where we're comparing miles driven per monthly active connection, rather than trips. We see a similar start to the story with a sharp decline at the outset, but as the pandemic continues, we begin to see a narrowing in terms of the gap between average mileage for 2019 and 2020. The light blue counterfactual actually tends down over the past several months in this analysis, and that's likely due to people going back to school or the weather not being quite as nice and feeling less inclined to go outside, or all the summer trips that people went on being well in the rearview mirror at that point. What we see in terms of average miles tells a different story than average trips. For average miles, we're actually very close to the level we were pre-pandemic.
Yeah, and this is really interesting. And I think it's important at this time to really draw back what we observed in these trends and how that can impact what companies are seeing from an insurance loss perspective. So we've seen historical relationships of mileage driven really being correlated with accident frequency on the road. However, it's really important for us to understand that this relationship is not a one-to-one relationship. The reduction in mileage that we observed back in the springtime months did not result in a one-to-one reduction in total losses for many companies. Even though they did report fewer losses, it didn't necessarily result in that same magnitude of change. And this can happen for a variety of reasons. A couple that we would like to discuss further in this presentation include the fact that insurance companies have different mix of business. So depending on where they're focused geographically, as well as some demographic information about the insureds that participate in their book, we actually do see that there are some mileage differences and differences in reaction based on those types of insureds. The second reason it's not a one-to-one relationship is because while mileage is down, which can lead to lower frequencies, some of the driving behaviors we've seen actually counter that effect on frequency because we've seen some more risky behaviors for some of those that we're tracking. So that could actually offset the decrease. And lastly, we want to think about severity as well. Mileage reduction does impact frequency, but it doesn't impact severity to the same extent. And in fact, some of those risky behaviors that I was just talking about can actually counter the effect and increase the average severities for those claims that are still coming through. So we're going to dig into a few of those throughout the presentation. And as we get started, Brian, I'm going to kick it back to you to start diving into some of those granular geographical differences we've been observing.
Sure thing. So on the next slide, we're going to have an animation that will allow us to understand a few different things. First, the story of the pandemic and how people responded to it is ultimately a local one. On the prior slide, we showed overall countrywide numbers that help us get a general sense of what's going on. But in order to truly understand the impact of the pandemic, you have to account for geographic differences in the driving population. What we find is that people responded to the prevalence of COVID quite differently. On the legend to the right, you'll see a color coding that shows two different metrics: the rate of COVID cases from left to right, and miles driven from bottom to top. The miles driven represents the last several days of driving, and the cases are county level reported cases of COVID. In the top left, you could think of that as what's considered normal, where you have a lot of driving and very few cases of COVID. In the bottom right, you'll see what might be considered an aggressive lockdown in response to a surge in local COVID cases. The dark blue in the top right shows instances where the disease is very prevalent, but people are still driving around a lot. The current picture is from March 1st, before the disease was really prevalent and before states started responding. This represents what can be considered normal. As we step through the animation, we'll see how people in different parts of the country responded. So, as we get into mid-March and mid-April, we see a sharp reduction in driving, similar to what we saw on the prior slide. You'll see that we have deep yellows, where locations reduce driving in response to a much higher rate of cases. But in the upper states, in states like Montana, we actually see a lot of light grays, which represents areas that reduce their driving even though cases hadn't emerged there yet. We're also beginning to see this dark yellow orangish color in pockets of the Southeast, Midwest, and the West, where cases are emerging, but driving is still relatively close to normal. Next, we start seeing a fair amount of blue show up in the Midwest and in certain areas of Texas, where people are driving a lot, but the disease hasn't started showing up there yet. Again, in the Southeast, Midwest, and West, we're still seeing that deep orange color show up where the disease is prevalent, but people aren't locking down as aggressively. In Southern California, the Northeast, and in Chicago, where Arity happens to be located, you see that the cases are surging, but people are doing their best in terms of locking down and reducing their driving. As we continue to move forward, we're going to start seeing some new colors show up. Some dark oranges and dark blues emerge as the rate of COVID cases are becoming more prevalent across the country. At this point, it looks like most of the country is fatigued in terms of responding to the pandemic. This is consistent with what we saw on the prior slide and also what we know about new cases. We understand that new cases are still emerging, but the driving patterns have gotten back pretty close to where they were before the pandemic. Regardless of how you choose to interpret or explain these results, telematics has allowed us to see and understand how individual counties and drivers have responded to COVID in a deep and meaningful way. If we move on to the next slide. In our analyses, we've actually found that the data can be fairly reliable even at the county level. So we're going to zoom in on a few select states and see how the pandemic has impacted them differently. The color scale to the right is relative to the counterfactual discussed earlier. It ranges from deep orange, which represents an increase over expected miles driven, to deep blue, which represents a decrease in terms of relative to expected miles. On the left, we see a state that most of you are probably familiar with. California still has significantly reduced driving miles across the state. But while the overall state has seen cumulative reductions of up to 40%, we do see some pockets of white and light orange where miles driven has largely rebounded or actually even increased since before the pandemic. Metropolitan areas like San Francisco and Los Angeles tend to see reduced mileage, while we notice more rural areas tend to be less significantly impacted in terms of reduction of miles driven. This is also a good reminder, excuse me, it's also a good reminder that the driving behaviors that we witness are often impacted by things that are completely unrelated to the pandemic. Case in point, the wildfires that California has experienced this year also had a significant impact on the affected areas in terms of the miles driven. In the middle, we have Georgia, which is going to tell a very different story than California. We see much more of a mix in terms of increasing and decreasing mileage patterns. The blue areas in the north central and the center of the state represent Atlanta and Macon respectively. But outside of those areas, we see a lot more rural locations have actually significantly increased their mileage since the start of the pandemic. And finally, on the right, we have Illinois. So Illinois has quite a few drivers, but actually about half of them are in the Chicagoland area, in the northeast corner of the map. So we're still seeing depressed driving miles in Chicago and the surrounding suburbs, but we also see that there's a wide variety in terms of differences between counties, actually even counties that touch each other. So all of this should be evidence that treating entire states as having responded similarly to COVID might be painting with too broad a brush. To truly reflect differences, you need to drill down into much more granular geographies. So we've looked at a lot of information here, and let's continue to dig a bit deeper into how drivers are individually responding. Megan?
Yeah, thanks, Brian. And I think it really is interesting to see how that differs, right, even within a state. And so we're going to dive a little deeper and jump into a different view of the mileage changes that can help us illustrate that even within county, we're going to see individualized responses in terms of mileage driven. So in these graphs, what we're doing is looking at average annualized mileage within each month for active users that were within our data set through from February through September. And what we did was we took a sample of these individualized users and grouped them into 3 different categories based on their initial response back in March when the stay-at-home orders were first being issued. The 3 groups are those that significantly reduced, which you can see here in purple, and those are drivers that had reduced their mileage by greater than 50% from February to March. Then we have a group that had reduced their mileage, just not to that magnitude. And our last group is actually drivers that had increased their driving in March. Those could be drivers potentially that were preparing for the stay-at-home orders, maybe getting their groceries, doing some of their errands, really preparing to quarantine and lock down. Or they could be some of those drivers that were actually helping out businesses and helping out with deliveries. Now, what's interesting, on the left here, we see the countrywide results. And in April, even those that had increased initially, everyone saw their average mileage go down. And that was during the heart of the stay-at-home orders. However, for that same group, the increasing group, they rebounded back to their February levels and actually above their February levels and have stayed there since the summer months. Whereas those that had significantly reduced have also been slowest to return closer to their normal levels. Now, Brian jumped into California on the prior slide and showed some of those differences by county. We wanted to dig into that state again and show how these individualized driver responses look for that state as well. We did the same thing, same grouping based on significantly reduced, greater than 50%, lower, reduced, and increased. And what you'll notice is a very similar pattern. It's almost hard to distinguish the difference in the pattern in California's individualized driver response and the countrywide response. But you do see here that the magnitudes are a bit different because California is still a bit lower in terms of its overall average mileage reduction. So here again, if we looked at those that had just reduced, they've stabilized closer to 20% below average, whereas countrywide is closer to that 5% mark. And for those that had significantly reduced, they're almost down 40% still, even at the more recent September data, whereas countrywide was closer to 25%. So there are some differences here. But what's really interesting to see is just how individualized these responses have been and can be, because it will vary based on everyone's own circumstance. Whether they're already going back to work and resuming their pre-COVID commute patterns, whether they're continuing to drive to support local businesses, or some that are still sheltering, like Brian and I, where our office is still closed and will remain so at least through until next summer. So early on, we wanted to look at these differences and changes because we anticipated there might be some that had increased. And what we anticipated back then was that some of those that had increased their driving were likely due to gig or delivery driving, right? We knew as a lot of these restaurants and businesses had shut down and were not open for in-person business, that there was a large influx of need for people to be delivering these goods and services. And since some insurers have extended their personal lines coverage to help these drivers out, I'm going to send it back to Brian to dig in a bit more on what we've found in terms of the gig trends that we've been looking at.
Yeah, it's a great point, Megan. It's not just how much people are driving, but also why they're driving. Um, Drivers for these gig economy platforms, so think Instacart or DoorDash or Lyft, where you're transporting food or delivery food or people. They might be exhibiting different driving behaviors than those that are driving for personal use only. So we wanted to dig in a little bit deeper on that. Arity has a suite of predictive models targeted for insurers and other companies that just want to understand gig driving a little bit better. Our gig detection model applies machine learning techniques to discern patterns typical to personal and gig driving. Once we classify a trip as either personal or gig, we can further analyze the impact of the pandemic on how people participate on these gig driving platforms. We see that while personal trips reduced roughly 50% early on, gig driving only decreased about 30%, suggesting that there is perhaps more motivation to drive for gig work than for personal reasons. As we look throughout the pandemic, it looks like gig driving actually rebounded more quickly in the first few months, but actually has, as the pandemic was worn on, dropped back down to near its initial trough. While personal driving is actually up since its low point in that mid to late April timeframe. So it's really interesting that we could see these shifting behaviors on a month-to-month basis. On the right-hand side, we're going to dig a little bit deeper and look at the different types of gig drivers, as there's actually variation among people that are driving on these platforms. What we see that those who are the most active, what we'll call them full-time gig drivers, those driving more than 40 trips per week, they remain close to their level of activity, even during the heart of the stay-at-home orders. So relatively little dip there. And they actually only recently started dropping off in the last several months. This could perhaps be driven by a reduction in demand as more individuals are returning closer to their pre-pandemic driving patterns as we saw earlier. On the flip side, those more occasional gig drivers, those with fewer than 20 trips per week, they saw their mileage reductions that are much more in line with those that we saw with personal drivers. So Megan, what does this all mean for insurance companies?
Yeah, good question. So I mentioned earlier, we know that some companies have extended coverage for this delivery type driving on personal auto policies. So it's important to understand there does appear to be a greater percentage of trip exposure in this gig space than in personal, which could increase expected losses for that group now that we have that coverage out there. And I think this view continues to highlight that while overall miles reduced for some, there are still those drivers that remain on the road, and they can be the type that are driving to multiple different locations and sometimes in unfamiliar areas, such that the type of insured risk prevalent on the roads, and especially that was prevalent during the springtime months, was changed a bit. So it's good to understand how that could correlate to the experience that insurance companies saw.
Yeah, thanks, Megan. I think that's really important context to keep in mind. So what we found is that we could learn a lot about the impact of pandemic by focusing solely on how much people are driving on a daily basis. But mileage is only one part of that impact. How you drive and when you drive are also extremely important pieces of information that telematics brings to the table. So let's start with Megan walking us through the value that driving behaviors can add to evaluating risk.
All right, thanks, Brian. Yep. So we've talked at length already about how mileage trends can help us understand that potential impact on loss. But again, because we have this access to telematics data and these other behaviors, it's important to understand that these other driving behaviors can help us understand it even better. So what you guys are seeing on the screen right now is what we call a two-way lift chart. And two-way lift charts help us understand the comparison of our models. It helps us understand whether or not we're able to accurately predict risk leveraging certain variables. So what we're showing here is how we can understand the power of model predictions that incorporate telematics-based data compared to model predictions using what we'll call traditional rating characteristics alone, where traditional rating characteristics can include things like territorial rates or information about the vehicle or even coverage limits. All right, so in this view, we are comparing the predicted loss ratio relativities. And when I say loss ratio relativity, that means this is a comparison of the actual losses observed for each of these individuals divided by what we predicted those losses would be using the variables within each model. And here you can see we're comparing that for two different models. This one is that traditional rating model, which includes those traditional characteristics. And this is that same traditional rating model with the addition of verified mileage. And when we're looking at these comparisons, what our goal is to best predict those actual losses such that that ratio, actual divided by predicted, is 1.0. That means that we've gotten it right. And so the way that we can compare these models is by seeing which model evens out our predictions to get closer to that 1.0 line across all of the distribution of our drivers. A perfect model would hug 1.0. So here what we can see is by bucketing these based on those that have lower mileage up until those that have greater amount of mileage, we see that by adding verified mileage in, we're able to get much better in terms of our understanding of risk, such that any companies that are not including mileage as part of their rating plan would be missing out on an important predictor of loss. So adding mileage into a rating plan is good. And we know in California that is part of the rating plan. And I know there are a lot of representatives familiar with that state on the line. But as we shift into our second chart, what we find is that adding other driving behavior helps us understand that risk even more. So here we're doing and looking at another similar lift chart, but now we're comparing two different models. This is that same traditional rating plus verified mileage model I just talked about. And here in pink, we're comparing it against a new model where we've added other driving behaviors like speeding or sudden braking. Now, the graph looks a little different this time because we're comparing two different models, such that group 1 is now representing those safer behaviors, such as driving at safer speeds, where group 10 now represents the more aggressive behaviors. But the comparison still means the same thing. We can see that by adding in these other types of driving behaviors, we're able to get our loss ratio relativity line much closer to 1.0 across the board. Now, the scale's not shown here, but they are on the same scale. So what's more interesting is that layering on these additional behaviors on top of verified mileage helps us better understand risk even more and across the board. You can see the improvement across all of the groups and deciles that we're looking at. Whereas verified mileage alone, while it improves, tends to improve only for the highest mileage and lowest mileage drivers. So what's important to understand is while understanding these mileage changes is going to be important for any company to understand the shift in risk, better understanding how these other behaviors have changed is going to be valuable as well. So I'm going to pass it over to Brian, who's going to start digging into more of the how and when behaviors and how those have changed in 2020.
Yeah, thanks, Megan. In the early days of the pandemic, when we first started looking for impacts on driving, we observed a noticeable shift across most of the driving behaviors that we review. But like in other arenas, as you increase your ability to precisely measure something, you begin to ask more refined questions. With our wealth of data, we continued to ask questions about and explore the data until we found that the shift in driving behaviors was not spread evenly across all experience. Specifically, we found that how people were driving varied significantly based on when they were driving. We identified 4 time periods as exhibiting different patterns worth discussing: morning rush hour, afternoon rush hour, weekend nights, and weekday midday. Over the next several slides, we'll discuss how driving behaviors that matter from an insurance risk perspective vary across those time buckets. First, we'll look at average speed. For the 2 rush hour time periods, We see a pretty dramatic shift early in the pandemic as lockdowns went into place. The average speed quickly rose 10% in the early days of the pandemic and remains elevated even today. People started driving faster during these rush hour time periods, likely due to less congestion on the road, which we observed earlier with the fewer average trips taken. Weekday, midday, and weekend nights, which are periods that are generally less prone to congested roads, saw average speeds much more in line with what we saw in 2019, which gives further credence to the idea that the rush hour shift is related to congestion, or rather a lack thereof. It's also interesting to see that average speed changed quite a bit during holiday travel periods. By looking at just the holidays, we can identify important differences between 2019 and 2020. Looking at the rush hour periods for 2019, we can see four distinct blips around Easter, Memorial Day, 4th of July, and Labor Day. Compare that to 2020, we see barely any change for Easter because that was right during the heart of the stay-at-home orders. While we do see noticeable increases in average speed around the other three holidays, the difference is not quite as pronounced in 2020 compared to 2019, probably because the average speed was already elevated in 2020. If we dig in a little bit further and look at a more refined view of speed, we could focus on aggressive speeds, those over 80 miles per hour. Similar to the prior slide, we're seeing higher rates of aggressive speed in the morning and afternoon rush hour time periods. However, unlike the prior slides, these changes appear to be opening up and actually more gradually expanding compared to that sharp increase we saw on the prior slide. We don't see one dramatic shift like we did with average speed. Instead, it looks like people are becoming more and more comfortable driving at these high speeds as the pandemic continues, and they're recalibrating to driving on these less congested roads. This is interesting when you factor in that we have seen that miles driven and trips taken are actually approaching their pre-pandemic levels, but these high speed behaviors are actually still elevated. So as we continue to monitor these behaviors, we're looking forward to seeing what happens as more drivers return to their more normal driving behaviors. Are these high speed behaviors going to snap back to what we saw prior to the pandemic? Or are people's behaviors just changing in general, and we'll continue to see this regardless of how much congestion is on the road? This question is particularly important for the weekend nighttime group. While the 2020 rates of high speed were at or below the 2019 levels for much of the pandemic, recently we've noticed that there's a divergence and that these high speed rates are becoming more common. Given that the late night tends to be among the riskiest times to drive due to reasons like driver fatigue, reduced visibility, or just the prevalence of more intoxicated drivers, the fact that this appears to be higher rates needs to be monitored moving forward.
Yeah, and Brian, I want to jump in quick because this view really is important, in particular these high speeds and how that has evolved over time. In a separate analysis that Arity did, we observed that there was a shift in the distribution of our own detected collision occurring at these higher speeds. So more of the accidents we were detecting were occurring at these high speeds. And that's important for insurance companies to understand because accidents at 80 miles per hour and above can result in higher damageability in both the damage to vehicle as well as the likelihood that there are bodily injury related losses. So this just ties back to the point I was making earlier that the mileage reductions themselves might not correlate to a one-to-one change in reduction of loss because some of these driving behaviors actually counter the effect and could increase the severities that we see. Brian, I'll turn it back to you so you can delve into a few other behaviors.
Yeah, I think that's a really good point and something really important to keep in mind. And actually, this next slide is going to give us even more to think about in terms of those high speed collisions. We're looking at aggressive acceleration here. And again, we notice another pronounced shift, but this time in the exact opposite direction of what we saw with speed. People are accelerating less aggressively. Again, likely in response to less congestion on the road, but there might be another factor at play here. With many of us working remotely now, it's possible that the reasons for driving during the morning and afternoon rush hour time periods might be different now compared to before the pandemic. That is Rather than rushing to get to work or get home, individuals might be engaging in other activities that are putting less pressure on them to get to their destination quickly. And while congestion might be a contributing factor to less aggressive acceleration during the rush hour time periods, that explanation fails to explain why we're seeing this change for weekend nights as well. While we're still evaluating the data here, it's possible that our typical driving behaviors during rush hour are leaking over to other areas of driving. Perhaps people not feeling as compelled to drive aggressively during rush hour is translating over to other times of day and making them just less prone to engage in these types of aggressive driving behaviors. And finally, we'll look at sudden braking, where we see a similar story, but there's still a few insights here. For the rush hour times, we see a relatively noticeable shift early on in the pandemic, and that has carried forward and actually expanded today. For weekday, midday, and weekend nights, the shift has been more gradual and it has expanded over time. Couple this observation with the higher average speeds we discussed earlier and the congestion versus mindset explanations for why these behaviors might be changing, uh, ultimately could be explained by drivers either engaging in less aggressive driving behaviors like tailgating, or maybe they're just generally driving in a more predictable, less frantic pattern. Compared to earlier in the pandemic, we've seen different driving behaviors emerge. For some, we tend to see a quick shift once the lockdown started, whereas others, we saw almost no change early on, but we've seen a gradual shift over time as the pandemic matures. So we're starting to see a lot more nuance in the responses to the pandemic as it continues to grow.
Yeah, that's a great point, Brian. Really, one that we need to continue to keep an eye on because behaviors like aggressive acceleration, aggressive braking, as well as those speeds are commonly used to help us understand risk, especially as the industry has been moving toward pricing insurance a bit more based on how drivers are actually moving rather than those traditional proxies we've used in the past. So, along with the shifts we're seeing in when people driving or how much they're driving, behaviors associated with less tailgating, like Brian just mentioned, could change the level of significance that these risk factors bear for helping us understand and predict expected loss. So it's really important for companies to keep an eye on these trends to understand if there will need to be adjustments to the amount of weight they place on each of these behaviors if they are starting to leverage them and use them in rating. That said, I still believe we're a ways out from understanding whether these types of behavior shifts will be sustained. Now, there are some that we can see that probably won't rebound in the very near term, but it's hard to tell if that will be the case into next year. This is why we continue to monitor and evaluate the data among all of these trends to see if there are any changes that we're observing. All right, so we've talked about how mileage and behavior trends have changed. But something that Arity has also observed is that drivers are also changing. They are becoming more aware of their driving habits, as well as how that could or could not impact their insurance. So, with that, I'm going to transition and shift to an update on something very important to insurers, and that's the consumer mindset. All right. So I mentioned earlier, but at Arity, we regularly conduct surveys to understand how comfortable customers would be with having their insurance company use specific driving behavior characteristics as part of the way that their insurance policy is priced. So we refreshed our survey, and the question we ask here is, how comfortable are you with your insurance company using this item to price your auto insurance? What we see was last year, roughly 40% of people were willing to use miles driven as well as distracted driving as part of that insurance policy rating. But roughly only a third of people would be comfortable using some of the other driving characteristics we talked about today, which includes time of day, driving location, and speed. Now, I've been working in insurance for over a decade, so has Brian, and we have been focused, or some of our colleagues have been focused on insurance telematics for about as long. And it's taken about a decade for us to get to those 2019 levels where we saw about a third acceptance of some of these behaviors and build that level of trust. So while sometimes for us in the telematic space, we've been discouraged to see numbers still that low, we remember when they were a lot lower. That said, what we saw this year is something really interesting. When we reran that survey in May of this year, those numbers increased dramatically and across the board. It's the most dramatic jump in customers' acceptance of telematics since its inception. So clearly, what we can see here is that telematics in all of its variations are having a bit of a moment that doesn't really appear to be going away anytime soon, as people are becoming more comfortable with being rated on how they drive rather than some of those traditional proxies, or at least placing some more weight on some of these controllable factors. One other side note related to some of the surveys and things and trends we've been studying related to shopping is that loyalty is no longer insulating an insurance company's book. We've noticed that 22% of all insurance shoppers in 2019 were considered high value. That's those that represented better risk characteristics with fewer traffic violations and more insurance products to bundle. And what we've noticed is having programs designed to attract those types of customers, like telematics, where we know we can do a good job of helping insurance companies target and more appropriately price based on actual driving, is crucial. All right, so I told you it'd be a lot of content, but we made it. Before we move to some questions, I did want to do a quick recap of what we discussed today. So first, Brian started with sharing how mileage is still down countrywide, as some Americans have been hesitant or can't really return to normal, but we are much closer than we were back in March and April. And then we also saw that impactful animation, which highlights both where we do and don't see that correlation and interaction between COVID cases and mileage driven. And then we also talked about how individualized each of these responses can be. We did dive into how some of those riskiest behaviors have changed and how that can look different by time of day. And lastly, we learned that customers are more willing than ever to allow all of these behaviors to be used for pricing risk. So hopefully all these insights and up-to-date analyses have given you a clearer understanding of how things continue to evolve to help you and your business navigate this unprecedented time. But for those of you who have engaged with us in the past, feel free to reach out if you have any questions on this analysis. And those that haven't, we are happy to be of any help in digging deeper or bringing additional insight that might be of use to you. So with that, let's see if we can't address a few questions. And I do think I have to stop sharing if I haven't already. Good to be able to see these questions.
So Megan, I think Nancy Trejo asked a question, I think, about the three groups of drivers, the reduced, the significantly reduced.
Yep, I'm
and
seeing it.
asked what percentage of all drivers fall into those categories.
Yeah, so the numbers vary a little bit based on the countrywide and the California numbers. Countrywide, it was roughly 25% were in that significantly reduced bucket, and that's those that had reduced their mileage by more than 50%. And then conversely, roughly 25% were also in the increased category. So roughly 50% were in that they reduced, just not as great of a reduction. California looks pretty similar to that, although they had fewer in the increased category, and that shifted more to the significantly reduced category.
Then I think another one that might be good would be Alice Chen. You see that one? What is the impact on claims with driving behavioral changes? How does it line up with traditional rating factors? Does it accentuate or inverse relationships?
I am missing that one, Brian. Which one is that one?
The second from the bottom in the chat right now.
Oh, okay. So the impact on claims severity and frequency. So we touched on a little bit of this, Alice. From an impact to severity perspective, it kind of varies by company in terms of what they've seen. But from a severity perspective, we have seen in certain instances some increases, and that's based on supply chain related costs, repair costs, as well as some of the types of behaviors that are leading into these accidents, right? Those higher speeds. So from a severity perspective, flat and slightly above for some of the companies that we've been working with. And then from a frequency perspective, based on publicly released statements, we do see that companies back in March and April, especially, did see that reduction in frequency. But we just like to reiterate that it's not that one-to-one relationship because of some of these shifts in the behaviors that we're seeing.
Yeah, hopefully that helped. You see the one from Janet Ruiz? What is the age group that is driving faster at night? Did we look at this? I think we did.
Ooh, I don't know if we've yet, Janet, looked at age and night and that interaction. We do have a separate graph where we were looking at the different age groups based on, I think it was maybe oldest age on a policy. Again, aggregating the view to see if there is some sort of relationship, and we actually did see some difference by age group, not necessarily by night, where we did see older drivers were the ones that had reduced the most, especially in the springtime. And when I'm saying older, I'm cannot remember our cutoff, but it would be like for sure 60 or and above. And I can't remember the exact cutoff. Younger drivers weren't reduced quite as much as the older drivers were.
Yeah, and I think maybe an important thing to consider with that is that nighttime driving, that late night driving, usually represents a relatively small portion of a total driver's miles. So I think that when you try to cut it down too finely, you might run out of data to actually analyze. But it is a good question. I think it's something that we want to look into.
That is a great point. I think we see that, especially on weekends, right? That weekend late night driving represents only like 1% of trips in our entire data set. So that's why Brian kept highlighting like these times of day aren't really that congested. So any changes in behaviors are really helping us understand who's on the road and what's that looking like.
And we are right at time, but if we want to try to fit one other one in, I suppose we could try. A lot of people are asking, will the slides be made available? And I believe the answer is yes, right?
I think we can do that. Yes.
Um,
I think Olivia, I see a question about looking at the miles driven by income level or profession. No, we have not looked at that, and we don't necessarily. I don't think we even have that in our data set to create those types of cuts. Again, the data that we're working with is based on our partnerships with each of the different businesses we partner with. A lot of it is from our mobile app partners, but also our insurance company and shared economy partners as well. So we're beholden to, outside of the driving data, other information that they provide us, and no one's really sharing income related or profession related information with us, so we're not really doing those cuts at this time. All right, with that, I think might make sense to turn it back over to you, Ed, I think.
Absolutely, Megan. Yeah, me again. I can't help but think back to, when I got started, and I can remember very clearly sort of doing the right work for some of the states at Progressive with a pencil and a piece of, a piece of accounting paper and that sort of stuff, and going and telling the person running the state, that it was going to be a 5% increase. And looking at the presentation you and Brian just completed, I know that was supposed to be 1980, but it might have actually been 1880 or maybe even 1780. The sophistication that you guys were able to bring to bear on this problem is just amazing. And I know I speak for everyone here how appreciative we are that you guys came to share this with us. So thank you very much.
Thank you so much for the invite. Thank you.
Absolutely. All the best.
All right, we'll be reaching out with you on the slides so you can distribute them.
Great. Thank you. Well, good. Well, that was a wonderful talk. I'm so glad we had an opportunity to hear it. And I'm sure the next one will be absolutely in line with it. Let me tell you, if you have a question about insurance investment, financial statements, et cetera, and you're highly placed in an insurance company and you want to make sure you get the right answer for that, the next two people that are going to come and talk to us really are the go-to guys. Among the many market dynamics that they analyze, we're fortunate enough to have them here today to talk about one that sadly I think is starting to become more important again. And that's the impact of a dynamic that we'll call social inflation. And that's the impact that the legal system, frankly, has on the losses that we as insurers end up having to pay. This talk has been approved by the California Insurance Department for continuing education credit. To receive that credit, if you want to get it, it's essential that you locate, fill out, and return a Google form that you'll find in your chat menu. And I'm not sure if CPCU All Industry Day say, it's there. So I can't overstress the importance of you pressing that link, getting that form, and at the end of this talk, filling it out. And there'll be one more talk later today for which CE credit could be granted. So having gotten through that important detail, let me get to the much more important ones. And that is the distinguished backgrounds of